Okay, so there's something going on. Listen up. No BS in this video. The three stocks are actually Lockheed Martin, Raytheon Technologies, and Northrop Grumman. Those are the three stocks we're going to be talking about today. But you want to stick around and listen to this video because I'm going to explain why these stocks are on my radar, why these stocks could possibly be on ARK's radar for their new ARKX ETF. And honestly, if you're in the business of building up a strong portfolio, diversified portfolio with great businesses from different sectors, the aerospace and defense sector seems to be showing us some great value, and I'm going to show you why in this video. Now, quick housekeeping, if you're new here, hit the subscribe button down below and hit the bell as well for new videos like this. And if you're a returning subscriber, welcome back. Smash the like button down below. You know how we do it on this channel. And guys, just in case you missed it, I actually did create a new channel, Positive Investing News, where I'll be focusing on kind of daily news, things that just, I need to talk about, but I don't want to clog it up on this channel. So you definitely want to subscribe to that channel as well, because it's going to be a lot more stock market talk. And it's going to be more, quick, off the cuff, share my opinion, and provide my perspective on what's going on in the markets. Okay, so now the question is, why do I think that these companies can actually fit into ARK Invest's new ETF, the ARKX? So remember, a majority of the fund will actually look at stocks that are leading, enabling, or benefiting from technologically enabled products and or services that occur beyond the surface of the earth. This is taken directly from ARK's SEC filing. All three of these businesses that I mentioned fit into this category, and whether ARK buys them or not, they're incredible companies and you want to potentially have at least one of these in your portfolio. So let's start off with the big daddy, Lockheed Martin. Lockheed Martin is one of the premier players in the aerospace and defense sector. Over the last 5 years, this has been a very consistent stock for investors, moving from around $200 per share to a high of nearly $450 per share. But the last 1 year has been a bit turbulent for this stock, thanks to everything going on in the world, thanks to the government shifting in the US, thanks to who knows what. But this has resulted in Lockheed Martin down over 21% for the year. A stable, blue chip, dividend paying, dividend growing company down 21%, you got my attention. As of recording this video, Lockheed Martin sits at a $95 billion market cap, plus or minus a little bit, who knows, it may have fluctuated by the time this is out. But regardless, it is a sizable blue chip business. This is what I found remarkable. In 2020, Lockheed Martin somehow grew by nearly 10% and is expected to grow again in 2021 by 4.3%. To see growth in this sort of economy, with a lot of headwinds really for this business, tells me that their products, their services are in demand regardless, and that excites me as an investor. Now, as a cherry on top of their growth, they pay out a stable dividend of over 3% right now, which has grown nearly 10% year over year for the last 18 years. Combine this with a low payout ratio and we have a stable dividend stock as well. And their fundamentals just keep getting better and better. They are expected to have a forward P of around 13 by the end of 2021, which is dirt cheap in most markets. But in case you've missed it, this market that we're in is extremely expensive. So to see a stock with a PE this low is a absolute steal. Now, Lockheed also backs all of this up with a strong balance sheet. Their assets here are strong with $3.5 billion in cash, $20 billion in current assets, and over $50 billion in total assets. And comparing this with their liabilities, they have $15 billion in current liabilities, which is covered by their current assets. So no concerns there of insolvency. And then if you look at their long-term debt, it sits at $11.6 billion with total liabilities of $45 billion. So we have a typical balance sheet here, assets greater than liabilities. Things look good amount of cash, manageable debt. No concerns here from a balance sheet perspective. Now, based on all the information that we've seen, with Lockheed Martin being one of the big players in aerospace, it's hard for me to imagine ARK not buying this for their ARKX ETF. In fact, just a couple of weeks ago, ARK did buy some Lockheed Martin for their ARKQ fund, so it's already kind of pre-qualified as a business that they approve of and the stock that they find interest in at these current prices. Next, we have Raytheon Technologies. Now, this is a stock that I've discussed on the channel quite a few times in 2020. They are a recent merged company of United Tech and Raytheon. Now, Raytheon hasn't had the best performance in the last 5 years, mainly because of 2020 when they got hit hard due to their direct relationship with Boeing, who is still hurting, by the way. In fact, guys, in the last 1 year, we have seen nearly a 30% decline in Raytheon, but this is still an incredible business and buying opportunity. This pretty much checks the same boxes that Lockheed does. It's a stable business, incredible company, well run, dividend payer, and it's down significantly. Now, Raytheon is slightly bigger than Lockheed because of their recent merger, sitting at around, just over $100 billion market cap. But remember, this is a newly merged company, which is why it's so big. Now, while 2020 hurt this business badly, next year expect to see a bounce back with some modest growth. Now, in my opinion, it's completely understandable to see because Boeing, one of their largest customers, is struggling right now. They have a lot going on, with the 737s and the grounding and 2020 and, all of Boeing's customers suffering. Yeah, that whole industry is a mess right now. It's going to come back on track at some point, but it's going to be a little while. Luckily for Raytheon, they also focus heavily on government, defense, so we're still okay here. Now, similar to Lockheed, Raytheon also pays a strong dividend, just under 3%, but they've been paying this dividend for 27 years now, thanks to the history of the companies prior to merger. So there's no fear, in my opinion, for any dividend cuts right now. In terms of valuation, their PE is expected to be under 20 for 2021, which is higher than Lockheed Martin, but still significantly lower than the broader market, signaling possible opportunities here. Looking at Raytheon's financial standing, their balance sheet looks good. Cash of $10 billion, with a lot more expected to come in this year, and total assets of $162 billion. The one concern is their very high goodwill of $95 billion. And while some of this may hold value to the company's history prior to merger, not all of this, in my opinion, can be used for actual money if required and push comes to shove. So you just got to keep that in mind while owning this business. This is an intangible after all. Now, the company does have good amount of liabilities too, $35 billion in current liabilities, $31 billion in debt, and $92 billion in total liabilities. But because they're such a large business, because they have so many assets, even if you take out the goodwill, it's still not a bad balance sheet. It's still a well-run company. It's still a combination of two incredible businesses, like we talked about, merged into one. So I think this company is absolutely fine for the foreseeable future. Now, if this was trading at fair or premium valuations, that's a different story. But like we said, Raytheon's down 30% from its highs. So looking at that, putting that into consideration, it's hard to ignore this name, and I'm sure ARK is considering this as well. So now this brings us to our third company here, which is Northrop Grumman. This is another good-sized aerospace business that I think gets overlooked quite often, and I don't think I've ever discussed it on the channel before. The last 5 years has been great for the company, providing good returns to investors, but like the other two, the last 1 year has been rough, resulting in a 21% decline for shareholders. Again, just like the other two, this was due to things out of their control because of 2020 and everything that happened. Their industry just got destroyed. It collapsed overnight, and these companies are just kind of building back from that now, at least for that sector of their business. Now, this is a smaller company, slightly under a $50 billion market cap, giving it a lot more potential upside. Now, surprisingly, they have modest growth in 2020, and they're expected to see similar growth here in 2021. Nothing too crazy here. Good growth last year, good growth this year expected. And I think this will just be one of those companies that just keeps chugging along. But you gotta keep everything into consideration. Remember, their industry is hurting. So to see any sort of positive growth, especially in 2020, that's a sign of a well-run company. That's a sign of a well-diversified company in this space. And that's maybe why you want to consider this, or at least add this to your watch list to look into further. Now, you guessed it, yes, this company also pays out a dividend, around 2% today. And while it's smaller than the other two companies, they are growing faster and have a lower payout ratio, meaning they can raise it quite a bit more than the other two. Now, in terms of PE, this is a significantly cheap business, guys. This is dirt cheap, under a 13 PE next year, despite growth and despite strong fundamentals. The market is just really not liking this sector right now. It's out of favor, if you will, and this is why we need to really spend some time to look into these businesses. Their balance sheet here shows strong assets, $5 billion in cash, $14.5 billion current assets, and nearly $45 billion total assets, whereas liabilities, it's manageable, $10 billion in current liabilities, which is covered by current assets, and then $14 billion in debt and total liabilities of $34 billion. So again, with balance sheet, it's not bad. Just like the other two, they're decent balance sheets. They're not like out of this world, oh my god, I gotta own this company because the balance sheet's incredible, Facebook style balance sheet. No, it's not like that. But it's a good enough balance sheet for me to gain exposure to this sector through companies like this. Now, I think this could be a good ARK candidate because like the other two, it's in this sector, of course, But, you know, it's down 20% and it's a smaller company. It's not as large as the other two. So it could have more upside if they can get the business to start growing double digits again. They could be a $100 billion company at some point, you know, doubling their valuation today. Whereas the other two may take a bit more time to double because of their size right now. And who knows, maybe ARK considers that into their valuation metrics and it's a possible candidate for them. Regardless, these are all three incredible businesses, whether ARK buys them or not. I am seriously looking into these companies because I like what I see right now. Also remember, in ARK's ETF, the ARKX that's coming out soon, they're going to probably hold, if history tells us anything with their other ETFs, between like 30 and 50 holdings. So there's going to be a lot more other stocks, but I think these three should make the cut because they're kind of the best of the best when it comes to aerospace. But anyways, guys, let me know in the comments whether you think these companies will be added to this ETF. Let me also know if these companies are of interest to you to add to your personal portfolio because you like what you saw here and you're gonna do some more research and you're gonna come to the same conclusion I did, which is these companies are dirt cheap. I know some of you in the comments have mentioned Lockheed Martin, so it got me looking into it and I like what I see. Anyways, guys, thank you so much for watching. Hope you enjoyed this video. Don't forget to invest positively and I'll see you in the next one. Peace.